What's the first thing that comes to your mind when you hear someone mention the stock market? Is it bad news? A market collapse? A huge opportunity for investors to make money? A roulette wheel? Or does the image of some boring dude on television talking in a monotone voice over a bunch of numbers come to mind? Well, I've been thinking, especially in the wake of all this trade war news we've heard over the past couple of months, it would be a good idea to once again go back and look at the history of the stock market. Today, I'm going to try and lessen some of the concerns that some of you may have when it comes to investing in the stock market itself. It's not very lucrative, at least in comparison to the fear-inducing headlines we see every single day that get people to click in record numbers, but it can be very helpful. And that's especially true for those of you who are new to the investing world. So, with that being said, how risky is the stock market really? But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. So something on the mind of many new investors right now is probably risk. Some have said that playing the stock market is essentially like gambling, but is it true? And how likely is it for you to actually make money investing? We're going to find that out today by going through the history of the stock market, looking at the performances of the S&P 500, Dow Jones Industrial Average, and NASDAQ Composite to figure out how often the market is up and how often it's down. Let's get started with the S&P 500. For the S&P, we're going to be going back all the way to 1928. And in 1928, the S&P 500 was valued at about $17 a share. Over the next 90 plus years, it would grow from that $17 per share to upwards of $3,000, give or take, per share as of the writing of this video. That's around 170 times its value in 1928. However, like all of the indices we'll be looking at today, the S&P 500 has had its fair share of ups and downs. Its most notable crash came right near the beginning of this time frame. The 1920s were, for the most part, a great time for the markets. There's a reason they're referred to as the Roaring Twenties, after all. It seemed as if investors could do no wrong. However, that would not last. The S&P 500 would reach a then all-time high of $31.71 per share in August 1929, before starting a slow but very significant decline over the following years. By the time the S&P had finally bottomed out, it was worth a mere $4.43 a share. That's roughly 70% below its all-time high set in 1929. And that, on its own, would have been enough to make it one of the most noteworthy and horrible stock market crashes in the history of the S&P 500, but that wasn't all there was to it. The Great Depression, as we now call it, lasted for what seemed like a lifetime. It would continue throughout the rest of the 30s and the rest of the 40s before finally setting a new all-time high of $34.24 a share in September 1954. Therefore, the Great Depression, as measured from the peak of the market to the bottom of the market and then back to a new peak, lasted over 25 years. A quarter of a century. But thankfully, the S&P 500 has not experienced anything even close to that bad ever since. Well, we have still experienced major crashes, most notably in the mid-1970s and the two of them in the 2000s, none have even lasted a decade. And there's another comforting thing to keep in mind when looking at the history of the S&P 500. Despite the Great Depression, and the dot-com bubble, and the housing crisis, the market has, from just about every measure, still been a good bet. Let's look at performance. From January 1928 to the end of July 2019, which is the most recent completed month that I have available to me at the time of this recording, the S&P 500 has had a little over 90 years of history to look at. During that time period, you could theoretically create almost 1,100 one-year stretches to analyze. You could create over 1,000 five-year stretches during that same time frame and nearly as many 10 and 20-year stretches. So that's what I did to try and figure out whether or not the S&P 500 is risky. Of the nearly 1,100 possible one-year stretches, the S&P 500 has been positive 68% of the time. Of all possible 5-year stretches from 1928 to July 2019, the S&P 500 has been positive 78% of the time, so even better than during the 1-year stretches. When we look at 10-year stretches, we see the S&P 500 has grown in 87% of them. And finally, when looking at all possible 20-year stretches, again from 1928 to 2019, we see that the S&P 500 has been a net positive investment in over 95% of all scenarios. What that means is, historically speaking anyway, you you have roughly a 2 out of 3 chance to make money investing in the S&P 500 if you only plan to invest for 1 year. You have nearly an 8 out of 10 chance of making money investing in the S&P 500 if you plan to invest for at least 5 years. And your chances of making money continue to improve as time you spend in the market increases. And this is also a pattern we will see play out in both of the other indexes. However, there is one thing that I did want to take a look at before moving on to the Dow Jones. And that's to take a moment to look at a more modern view of the stock market. Because much of the time spans that fail to make investors money happened during the Great Depression, as you would imagine. So what would the numbers look like if we started looking at them after the end of the Great Depression? As it turns out, they're modestly better. The S&P 500, since about 1950, has made investors money in 74% of all 1-year time frames. It's made money in 84% of all 5-year time frames, 93% of all 10-year time frames, and 99% of all 20-year time frames. So again, modestly better, and once you start getting up to those 10 and 20-year investing time horizons, you're almost guaranteed to make money, at least judging by the S&P 500's historical performance. The story of the Dow Jones is almost identical to the S&P, so I won't spend too much time on it, but like the S&P, it had a very good second half of the 1920s before falling into the Great Depression for about 25 years. It had a major crash in the mid-1970s and took a little bit longer to recover than the S&P did, but was still back up and running in the early 1980s. All would go according to plan until the dot-com bubble burst in the early 2000s, which was followed shortly thereafter by the housing crisis. This caused what sometimes is referred to as the lost decade by investing historians. But just like the S&P, the Dow did recover in the 2010s, which is the bull market we've been riding ever since. It should come as no surprise then that the frequency with which you make money investing in the Dow is very similar to what we saw in the S&P. However, I was actually able to get data from the Dow a little bit further back than I was for the S&P 500. So for the Dow, the numbers are based on data that I was able to find back from January of 1915 to July 2019. The Dow Jones made money for investors in 68% of all 1-year scenarios from 1915 to July 2019. It was positive in 78% of all 5-year scenarios and 85% of all 10-year scenarios. And finally, since 1915, the Dow Jones has been a net positive investment for us in 96% of all 20-year scenarios. We see the percentages improve if we look at a more modern view of things starting from 1950, just like we did with the S&P. The Dow has been a net positive investment for us in 72% of all 1-year scenarios since 1950. It's grown in 83% of all 5-year scenarios, 91% of all 10-year scenarios, and 99% of all 20-year scenarios, again, since 1950. So like I said, very similar to the S&P 500, give or take maybe a few percentage points. The history of the NASDAQ is admittedly quite a bit shorter than its contemporaries, but that doesn't mean that it hasn't had its own fair share of excitement. The NASDAQ composite began in February 1971. It was trading at a little over $100 a share at the time. And like what we saw with the Dow Jones and S&P 500 during the 70s, the NASDAQ was also pretty volatile in its first decade. Within the first 2 years, it had gained 30% of its original value. Pretty darn good. And that was when it set a new record high of $133.73 per share. However, a little over a year and a half after that, it had lost 60% of its value. The NASDAQ in September 1974 was trading for just $55.67 per share. The crash of the 1970s for the NASDAQ lasted roughly 5.5 years before it managed to set a new all-time high of $135.01 per share in August 1978. By and large, the NASDAQ performed similarly to its contemporaries in the 1980s. It experienced some volatility in the early part of the decade, but largely trended upward. And as you might expect, with a lot of tech stocks in it, the 1990s were a boom period for the NASDAQ. As a matter of fact, it never went more than 13 months that decade without setting a new all-time high. And by the time the NASDAQ reached its peak before the dot-com bubble burst, it was trading at nearly $4,700 a share. That was in February of 2000. So less than 30 years from the NASDAQ's inception, it was trading at nearly 47 times its original value. Talk about a great return. But the NASDAQ's toughest days were about to come. When the dot-com bubble burst, the NASDAQ was hit hard. Over the span of 2.5 years, the NASDAQ went from trading at $4,696.69 a share in February 2000 to trading at just $1,172.06 a share in September 2002. So in the span of 2.5 years, the NASDAQ lost 75% of its value, roughly what the S&P 500 lost during the Great Depression. So you want to talk about volatility, the NASDAQ in the 2000s seemed to have that in spades. And unlike the S&P 500 during the 2000s, which did recover slightly before the housing crisis hit, the NASDAQ failed to regain its previous high before the second crash of the decade. When all was said and done, the NASDAQ didn't set a new high until November 2014. That's not quite as bad as the Great Depression was for the S&P 500 in terms of length, but it was still very tough. However, similar to the S&P 500 and the Dow Jones, the NASDAQ since 2014 has been on a rapid rise. As of July 2019, it's trading at nearly $8,200 a share. However, despite all of that volatility, I'm happy to admit that of the three indexes, the NASDAQ has actually had the highest success rates when it comes to making money, historically speaking. Although you do have to take into account that it hasn't been around for quite as long, it's still an impressive feat. Since its inception in 1971, the NASDAQ has made money in 76% of all one-year scenarios. It's made money in 86% of all 5-year scenarios, and has had positive returns in 94% of all 10-year scenarios, and perhaps most impressively, despite all the volatility, it has yet to lose money in any 20-year time span. Now that is impressive. So while the past does not necessarily predict future returns, I understand that, I would feel fairly good about the stock market based on the data we have if I were just getting started investing in my 40s or early 50s. I would feel really good about the whole thing if I were investing even younger than that. Because it does seem that as long as we're in it for the long haul, investing in the stock market is almost always a good bet. That doesn't mean we won't experience a market correction at some point in the future. I'm sure we will at some point, I just don't know when. But based on the data we have, we can be reasonably certain that growth is still in our long-term future. But that'll do it for me today. Once again, if you haven't already, be sure to like this video as it really helps the channel out a lot. And if you want to learn more about the history of the stock market and the risks associated with investing in it, be sure to check out my video on the history of stock market crashes with the link on the screen. And as always, thanks for watching.